What's going on, everyone? Charlie here. We're going to talk about basically everything that's happened from 2019 COVID era until today. It's going to be about macroeconomics, things that have happened in the markets, but mainly going to be focused around the markets because that is where a lot of this driving narrative and inflation, of course, is stemming from. So we're going to start at the very beginning, back in September of 2019, when the Federal Reserve stepped in as the lender of last resort, utilized several tools at their disposal, such as government money market funds, prime money market funds, municipal money market funds, COVID-19, and a plethora of monetary policy tools that are some of which are still being used today. Let's go ahead and take a look at this. So, COVID prompted the following series of events. Number one, deploying the monetary policy toolkit. This was step one in the regime of COVID response. In light of the anticipated effects of COVID-19 on economic activity and on risks to the outlook, at two unscheduled meetings on March 3rd and March 15th, 2020, the FOMC cut the target range for the federal funds rate by a total of 1.5 percentage points, bringing it to the effective lower bound target range of 0 to 1/4%. In the statement accompanying the March 15 meeting, the committee also deployed forward guidance and said that it expected to maintain this target range until it was confident that the economy had weathered recent events and was on track to achieve its maximum employment and price stability goals. Now, the recent events that it's referring to, of course, is the rate crisis that occurred due in part because of COVID. Rates were very, very high, being lent by non-Fed. So the banks wanted the lower rates. So they had the Fed step in as lender of last resort, cut the Fed target to basically 1/4%, and go down the road. Now, at the same time, the committee noted that it would continue to monitor the implications of incoming information for the economic outlook, including information related to public health, as well as global developments and muted inflation pressures, and that it would use its tools and act as appropriate to support the economy. So the target rate basically fell from where it was at 1.75% all the way down to 0.25% back in early 2020. Now, open market operations for safeguarding market functioning. In order to ensure that the supply of reserves remained ample and to support the smooth transitioning and functioning of the critical funding markets, the Fed Reserve also took actions to expand the supply of short-term funding available to primary dealers to finance their increased holdings of Treasury securities and agency mortgage-backed securities at a time when funding costs from other sources were increasing sharply. This is what I was talking about when I was referring to the rates. So funding from other sources was becoming increasingly expensive because rates were higher from them. They would not want to lend at a lower rate, but the Fed would, which is why the Fed stepped in. Now, in particular, beginning on March 9th, 2020, following a directive from the FOMC, the Federal Reserve Bank of New York's open market desk increased the size of overnight and term repo operations. The desk subsequently introduced new weekly recurring 1- and 3-month term repo operations, introduced a second daily overnight repo operation, and increased the amount offered in each operation. Despite the much larger volume, however, of repo operations, strains in the Treasury and agency MBS markets continued to build. On March 15th, the FOMC directed the desk to increase its holdings of Treasury securities and agency MBS by at least $500 billion and $200 billion, respectively. On March 23rd, to provide greater flexibility in addressing the strains, the FOMC authorized purchases of those securities in the amounts needed to support smooth market functioning and the effective transmission of monetary policy to broader financial conditions. The securities targeted for purchase were also expanded to include agency commercial mortgage-backed securities. Now, if we take this to the repo chart and we look at what happened during this time here, it really does tell the story. So the decisions to ramp up the operations by the FOMC happened over the weekend on a Sunday, March 15th to be exact. And if you look at the chart, there's basically zero demand in the reverse repo market at this time. Next, if you add in the emergency meetings that took place, the second one took place here when we finally did start to see some demand in the repo, and I guess they were not ready yet because they didn't have enough collateral. So they had to figure something out to stop this from occurring. This is when liquidity and funding operations come into play, stabilizing short-term funding markets. The sharp increase in the demand for cash and other liquid assets in mid-March 2020 caused strains in many other financial markets, disrupting the flow of credit to businesses needed to fund critical operations. To alleviate these strains, the Federal Reserve deployed its most traditional liquidity tool and encouraged depository institutions to turn to the discount window to help meet demands for credit from households and businesses. This is where the bail-in starts. Now, in support of this goal, the board announced that it would lower the primary credit rate by 150 basis points to 0.25%, effective March 16th, 2020. Notice how all this is happening before April 2020. Narrowing the spread of the primary credit rate relative to the general level of overnight interest rates was intended to help encourage more active use of the window by depository institutions to meet unexpected funding needs. To further enhance the role of the discount window as a tool for banks in addressing potential funding pressures, the board also announced that the depository institutions could borrow from the discount window for periods as long as 90 days. In addition, the Federal Reserve reduced reserve requirement ratios to 0% effective on March 26th, and also encouraged depository institutions to utilize intraday credit extended by reserve banks on both a collateralized and uncollateralized basis to support the provision of liquidity to households and businesses and the general smooth functioning of payment systems, or that's what they wrote down. But we all know, looking at the information that I'm about to show you, that's not the case. Now, the Federal Reserve, with the approval of the department, this is one of their most important moves that they made. One of them, a few actually. They made a few very, very helpful moves here that saved basically the whole economy. So, with the approval of the Department of Treasury, they also, and this is all prior to April 2020, announced the Commercial Paper Funding Facility on March 17th and the Money Market Mutual Fund Liquidity Facility on March 18th, benefiting from the blueprints used for similar programs established during the global financial crisis. The CPFF became operational on April 14th and the MMLF on March 23rd. These emergency lending facilities, keyword emergency, were established under Section 13.3 of the Federal Reserve Act. Each facility had $10 billion of equity provided by the Treasury Department to protect the Federal Reserve from potential losses. Now, they also created the Primary Dealer Credit Facility, which was announced on March 17th to provide fully secured loans against good collateral to the primary dealers that are critical intermediaries in short-term funding markets. Operations for this started March 20th. So now let's turn back to the repo chart. So, again, emergency meeting here. We had another one at the early part of March. But what happened between those two meetings? A lot. They added the Commercial Paper Funding Facility, Money Market Mutual Fund Facility, Primary Dealer Credit Facility, and that's not all of them. There was more. Remember, there was a Paycheck Protection Program, all that basically public consumer credit relief, liquidity relief, and they had a plethora of these tools all implemented right before this first little pop here. Then their emergency meeting takes place. So, among other actions to support financial intermediaries during the pandemic in April 2020, the board issued an interim final rule that excluded, on a temporary basis, U.S. Treasury securities and deposits at Federal Reserve banks from large bank holding companies' supplementary leverage ratio. This is the most important thing that they passed during the 2020 year. Why? It allowed them to free up their liquidity, continue lending despite pandemic concerns, and basically we saw BlackRock, Vanguard, and Fidelity buy up everything under the sun because they needed that collateral to basically lend in the repo market the following year in 2021. Now, the rule helped ease strains in the U.S. Treasury markets and facilitated the significant inflow of customer deposits. Now, hear me out. What did we all get? Why would there be a significant inflow of customer deposits to banks that had occurred since the onset of the crisis? Why would that happen? Because we all got stimulus checks. Now, they used these stimulus checks to leverage themselves up with collateral that they could then use the next year in April 2021 when SLR expired, right when Gary Gensler took office, to leverage all of this collateral and lateral it straight into the repo market, where they would then lend it to each other, and then they would put the market right back where it started, which is exactly what happened. Because the markets, they did not just crash, they did not go down. What happened is they were just deleveraged. That's all it was. So don't let it fool you. So basically, on March 27th, 2020, together with other regulatory agencies, allowed banking organizations to mitigate the impact of the current expected credit losses accounting standard on regulatory capital in order to allow banking organizations to better focus on supporting lending to creditworthy households and businesses. So again, I'm going to read this. This is the most important thing in this whole thing, this whole video right here. The rule helped ease strains in the U.S. Treasury market and facilitated the significant inflow of customer deposits to banks that had occurred since the crisis. The only reason that you would have a significant inflow of customer deposits during the pandemic was because of the stimulus checks that they then used to rehypothecate up to 10 times leverage and then used it to buy up everything under the sun. How do we know this? Go take a look at BlackRock, Fidelity, and Vanguard's portfolios. If you combine all three, just these three, FMR LLC, BlackRock Incorporated, Vanguard Group Incorporated, you get a total of $9 trillion in assets under management, which almost equals the Fed's balance sheet in and of itself. You add up the total amount of positions, 15,000 positions between just these three. And these are the top three primary money market fund participants in the repo. Now, let's go back to our chart here. So remember, we had all this stuff happen prior to this little pop in demand in the repo market. Then we had emergency meetings come into play in late March. We had all those emergency facilities established. And then what was the most important thing? The supplemental leverage ratio, which, if you look here, zero demand for a whole year. That's what the supplemental leverage ratio did. Now, what happened next? March 31st, 2021 is when that expired. And then look what happened following the expiration of SLR. They bought themselves a year. They got all the collateral they needed. The apes were born during this time. And now everyone's good and distracted for what's to come next. The reverse repo operations. What we've been living through. The Great Reset. It's been happening for the last year and a half. Now, there's one more part though. The charts of the market. So this is the repo chart, right? You have basically the repo demand was non-existent. There was a small blip between 2014 and 2018 when I believe they first started to do this, but they realized they couldn't because they had to transfer LIBOR to SOFR, which is a whole nother topic. But if you just look at this, early or mid to late March, all these facilities established, decision to ramp up operations by the FOMC announced March 15th over the weekend. Emergency meetings then followed. Then the supplemental leverage ratio was enacted and all demand ceased. Well, look at the charts. This is the exact same setup, but on a chart. So if you look at the markets. Boom, crashing, down, burning, 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 burning. Boom, we're right here. Then we get all of a sudden all these facilities. Emergency meetings. Then what happens? The SLR ratio relief rule was passed. And then what happened? The markets pump to the sky. And then what happens after that? The repo takes over, kicks it a little bit higher. And then as soon as the first of the year hits, all of a sudden the price starts going against inflation. So right here, inflation, 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 inflation. But wait, the prices are going down, but inflation's still going up. What could this mean? I think the MOAS is real, but it's not what we have all thought. It's the Fed. The Fed is the MOAS. Anyways, next time we'll talk about the next part, 2021, April to April.